What we're going to get into right now is his forecast for the next year. So you've already kind of mentioned a few things. You're expecting a little bit of a rough quarter. And what other elements of your forecast can you share that kind of are based in history and some of the reasoning you have for the forecast that you're making right now?
Well, we touched on a bunch of it, in the beginning. I think last year's action is a real basis for this year. I mean, had we been up a lot last year, I wouldn't be so bullish this year. Very typical midterm election year bear market, October bottom. I mean, I can't write this stuff. Oh, wait, we did write the stuff. But,
and you said it too. You said it here. So
I said it there. We said it a lot of times.
Yeah.
But, it doesn't always work out that way.
Sure.
It happened to be a very typical year. We had some help from exogenous events in
Sure.
Europe, supply chain issues and stuff with China, inflation, the Fed. So our forecast is choppy start, Fed pauses in Q1, and the pre-election year bull emerges. So it's based in history, pre-election year pattern, best year of the 4-year cycle. I know the Republican Congress is having a little issue getting started. I didn't see what happened today if they were able to elect a speaker, but there's still some positivity for the market. I mean, on a market analysis basis, on a political alignment issue, Republican Congresses and Democratic presidents have been the best combination for market returns with the Dow. If you look at, I think it's on page 10 or so of the Almanac, up about 16.4% if memory serves. So with a split Congress, it's still, double digit situation, but about 11% or so on average. That's going back to 49. So we've got, a little bit of gridlock, which helps tone down a lot of changes that makes Wall Street a little bit, nervous about what they're going to have to deal with. So that's a positive. The seasonal pattern, we've come up with something called we call it aggregate cycle, the Almanac aggregate cycle, where we take the seasonal pattern for all years, going back either 49 or 46, depending upon if we want to get, where we are after World War II, but post World War II. And then we take the year of the 4-year cycle. So that would be pre-election years this year. And then the decennial cycle, the 3rd year. And it really traces out quite well. Again, we combine that with, all pre-election years, as well as first-term pre-election years for a new president who's really trying to prime the pump to get reelected, which is what drives it. I think he's going to get some help from the Fed this year by them backing off, or at least, laying off the accelerator on the tightening. And, then you've got, after a bear market, a midterm bear market, you see pre-election years up on average about 20% or so. So we've got a lot of that 4-year cycle, tailwind help for the market. I look at sentiment also. Investors' intelligence has been bouncing around down there like it did with the bullish bearish difference, reminiscent of 08, 09 and other bear market lows. Just what you hear on the street, all of the commentary out there. I mean, everyone's going to take out the low, or not. There's not a lot of whole bullish, expectations out there. There's a few analysts that are looking for some upside. I don't know if you can use put call anymore. They've messed with that a lot. There's been some discussions on some of the threads I'm on where, with all of the other weekly options and binary options, it's really hard to get a proper reading on the equity only put call ratio that we used to look at a lot. But, anecdotally, things are pretty bearish. And then we got GDP solid. Okay. We had 2 quarters down. I'm going to call it a recession. I know they changed the rules during COVID, but 2 negative quarters GDP is somewhat of a recession. And then, consumer confidence has hit a new low. Again, a little contrary there. Inflation rolling over. And we've got our Dow still leading things. I mean, really holding up the market and not not falling apart like the techs. I think there's some support there. And again, with the Russell 2000 holding that June low and not even hitting a new low in October, let alone taking out the October low, didn't take out the June low.
Right. Well, and getting to that, like you were talking about the NASDAQ actually making a new low, and that kind of
and maybe we can show the chart.
You guys perked up on that because
exactly.
I mean, when I'm trading, I look at intraday activity, but when you're talking about the like the index, I'm always a close oriented guy. But the intraday area that you pointed out, I think is quite important.
Right. Right. The 10,088 on the NASDAQ, right, which was the CPI number that that was higher and the market gap down, and then by the end of the day you had that massive surge, which just from an intraday low continues to hold.
We also had our MACD seasonal best 6 months buy signal. We had those 2 big days in early October, which triggered it, which was kind of a darn, we were looking for things to go a little bit lower, and then they did with the CPI print that you mentioned. So, you can't pick all the bottoms and all the tops.
Right.
But if you get close,
you're close.
Yeah. So maybe you can discuss a little bit since we're talking about the technical action now, and we'll get to some of the resistance areas that you mentioned too. But just kind of focusing on the bottoming action, I guess one of the tricks here is that things have been so volatile. You've got, I mean, just look at that October 13th low after the CPI report. I mean, a big widespread. A lot of this has been headline driven. Whether it's the Fed, the Fed announcement, even though they do exactly what's expected, if Jerome Powell says something a little funny in the press conference, things go haywire. We've definitely seen a lot of big movements, between the high and the low on the days, especially on those.
You're seeing the market close like the opposite of the futures, the pre-market futures a lot lately.
Right.
That's interesting.
There's something I just thought of that I want to jump back to. Remember back in August, early August, everyone was all bullish.
Right.
And we had that summer rally, summer rally hype that we talk about in the Almanac.
Right. Yep.
And our aggregate cycle for 22, which was midterm, second years, and seasonals, really pinpointed that top, and it's an August top. Now everyone's bearish, not everyone, but a good amount. After we've had that October bottom, everyone thinks it's going lower. So again, contrary antenna purring, thinking about that. It's just, I tend to want to go the way that my analysis, my charts, my seasonals are going, and also against the crowd.
Right.
When it comes to these big turns, I mean, you're going to have to stay bullish when the market's going up. I mean, there's a time to be contrarian, and there's a time to go with the flow, to not fight the tape.
Right. Yeah. So maybe talk a little bit about some of the other resistance areas. So here we were. We had that strong rally in March. Then again, July, August. We had the October bottom, and it seemed like we were kind of getting a rally, but it was definitely not straight up. There were a lot of fits and starts back and forth. It kind of seemed like you couldn't make much traction. So the indexes were up, but it was a lot of back and forth in between there. So
I mean, everyone's talking about 3,900 now, 4,000, but I'm still looking at that August top as being a resistance level.
Okay.
What we just mentioned.
Right.
We've got to clear that. We got to get through and past the 200 days more, convincingly.
More than a couple days.
Yep.
And with some distance between it, and not cantilevered out there, just waiting to fall back down, but a nice cup and handle, if you will. And I think that's this is kind of like a wall of worries situation for me here. I think we're climbing it. It's gonna be a battle. There's still a lot of people that are short. There's still a lot of people that are skeptical, but I'm seeing less and less, bulls out there. And when everyone's a bear, who's there's a lot of cash on the sideline. We
Right.
Get back in, so
What about like market breadth? Are you taking a look at that and keeping an eye on that?
It's been following the market. It would be more constructive and encouraging to see some improvement there. But it hasn't been as divergent. Again, new highs and new lows. There's been improvement. We look at that in the pulse of the market feature that we have, which comes right out of the record keeping section in the back of the Almanac. We need more improvement there.
Okay.
But it's not as bad as
there are some things that are working, right? There are some areas that are working for sure.
There's been a lot of stuff, a lot less new lows. Most of the new lows happen in June, and we've seen less and less, and that's been an improvement. But it'll be more encouraging to see a lot more new highs. But you're not going to get that down here, at these levels.
Right.
So that'll be confirming if we can get the indexes to move above August and get advancers outpacing decliners and new highs swelling and new lows diminishing. That'll be more encouraging.
Yeah, one of the things we have on MarketSmith, we have NASDQ, which gives daily market indicators, and we use a 10-day moving average of the new highs and new lows. You can see that at the bottom for those of you that are at investors.com/podcast. You can watch the video, and you can see that pink line with the new lows has been dominant over the blue line of the new highs for quite a while here.
Just looking back at our pulse of the market, week ending, and I look at weekly stuff, old Barron style. Back on October 14th, there was 1,245 new lows, 86 new highs. Wow. And that number's come down. I mean, it was in a couple hundred each or so, thereabouts recently. Back at the end of September, it was 52 new highs and 1,575 new lows. So we've seen those go down. I mean, similar stats on advancers and decliners, but you're not going to get a new bull market or new highs when you don't have new 52-week highs,
right,
in the individual stocks. So,
and I was thinking maybe we also go ahead and while we're on charts, maybe pull up the Russell 2000, because you mentioned how the small caps, represented by the Russell 2000 here, kind of held its June lows a little bit better than the other indexes. So what kind of information are you taking from the different indexes as different pieces of the puzzle?
I mean, I mentioned 74 before, where it was sort of a scatter bottom. You had the Dow making a low in, was it S&P and NASDAQ making a low in October? Dow made its low in December. Russell wasn't really a factor back in 74. It didn't really start until 79. But you're seeing a similar situation of, not everything bottoming in sync, which is, a little different than everyone's used to, but it is what it is. I mean, you got that two higher lows in the Russell, and you also see in the other one sort of that nice, triple bottom situation with the, lower low in the mid, lowest low in the middle, except for NASDAQ, except on an intraday basis, as you mentioned. So the other thing was that period of time when the market made that October low is a period when there's seasonal weakness in the small caps versus large caps. Russell, fended that off. The 2000 fended that off. So a little bit, supportive, encouraging as well. But it's not going to be easy. This isn't, one of those straight 45-degree angle, bull markets. It's struggling to gain traction.
Yeah.
And you got to be patient and stick to your system, stick to your stops, and just don't be in a rush.
Do you think there's a chance that it's going to be choppy like that for most of this year? Because those are some of the things that I've heard is like it could just be kind of a short, intermediate rallies to the highs and then come back down, and you're just kind of stuck in a range for a while.
I think it's going to be tougher in the first quarter.
Okay.
Pre-election year bias there for me, and probably really strong in the fourth quarter. May get a little more 6 months sideways action. But you never know what happens with China, Taiwan, North Korea, Iran, Israel, Lebanon, Ukraine. Who knows? Aside from that stuff, we got to get the Fed to realize that it's, was behind, now it's ahead, to pause and let things take effect. But that inflation is hurting. I mean, I went out shopping with my wife to get stuff. We've got a couple of teenage boys. Got to stock up on protein bars and all that stuff, and geez, like a bag of pretzels, was like $5. It used to be 2 for $5, and we're like,
oh my god.
And the thing that I take away from that, just being a dad shopping for his kids is, that inflation. It's still mounting. It may be rolling over CPI and PPI and PCE and all that stuff, but at the cash register and at the supermarket for everybody out there, it's still building, and it's like almost playing catch up because we had inflation spiking in early last year, but the prices at the at the checkout counter were not what they are now. So there's a little bit of inflationary catch up hitting everybody in the pocketbook.
Yeah. So I mean, during that, going back to the first quarter of this year, the consumer, is projected to struggle quite a bit, and this is where they are going to pull back because of all the kind of experiences that you just mentioned.
And then there's the mortgage rates and that sort of thing.
Exactly.
Yeah, a bunch of people. I mean, hey, we got used to low inflation for a very long time. Ridiculous.
And low interest rates.
Yeah, absolutely.
I mean, 5% Fed funds is not historically high.
Right.
Yeah. I mean, recent history, yes, but I mean, I remember my brother, who's 10 years older than me. He tells me he bought a condo back in the 80s. Or his mortgage, I think it was like 13-14% or something like that. Yeah. Like his first, after college, new job kind of condo thing. And people are spoiled by not having to pay any interest on loans.
One other thing I wanted to kind of touch on, because you talked about this interplay between the small caps and the large caps. Any information you can shed on the difference between growth and value? Any seasonal factors there?
I don't see a whole lot of seasonal factors between growth and value. I think that's a little more rotation oriented, more cyclical, if you will. I know that word gets tossed around, but we're seeing a shift into value right here. That's why the Dow's doing what it's doing. Not as much of a seasonal thing, more of a business cycle and a market cycle type maneuver.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.